More AI talk. Unbelievable what's happening. Welcome back to the Dean's List, everyone. This week's going to be exciting. We are talking specifically about certified financial planning. And this is probably a service many of you are using to plan for retirement or even deal with your financial situation in retirement. And today we're going to talk about how AI specifically, how they're disrupting this multi-billion-dollar industry. And we'll go through some very, very specific situations that hopefully apply to some of you out there that'll show you that some of these financial planners that you see on YouTube, they are being disintermediated and that they're not really that necessary anymore. So let's get into it. CFPs have long been the go-to professionals for navigating retirement, budgeting, and investment decisions. They even take up lots of popular YouTube channels, as we talked about. But what you could create on your own is the same detailed plan and get very similar service without any fees. Is this crazy? Is this just a silly AI experiment? Listen, I worked through a real world scenario that I want to show you. And I did it because I want you to see how easy this is and replicate it for your specific circumstances. So let's talk about the scenario. We have a couple, we'll call them John and Jenny, and they're 55 years old. They're approaching retirement and they've got about $3 million in savings at this point. What's their goal? Well, they want to retire at 60. A little bit early and ensure that their wealth supports a comfortable lifestyle up until the age of 95. So they don't have any serious debt at this point, and they can live on about $120,000 per year comfortably after tax. So their goal is to maintain this lifestyle in retirement. And let's assume that the couple's got a couple of kids, and those kids are getting up into their late 20s, early 30s, and they're thinking about the next stages of their lives, which is, marriage, buying homes, etc. So a couple like this is probably going to want to help. So here's how ChatGPT created a detailed plan for them, step by step. Step 1, understanding their retirement needs. First, ChatGPT calculated the couple's annual expenses in retirement, adjusted them for inflation, and used a conservative 3% annual inflation rate. So their $120,000 lifestyle today turns into $139,000 by age 60 and $168,000 at 70. Now, to maintain their lifestyle, they need a portfolio that can sustain those withdrawals while growing to outpace inflation. Step 2, ChatGPT is going to help the couple set a withdrawal strategy. So the withdrawal plan that balances safety and growth is very, very important. And it's all built, and this is ChatGPT's knowledge base at work, around the 4% rule as a baseline. And 4% is generally considered in the financial services circles, right? The advisor circles, that 4% is a comfortable rate of withdrawals in retirement, so that you do not jeopardize your ability to outlive your assets. The AI tailored a dynamic withdrawal approach. What does that mean? That means that base withdrawals start at $120,000 a year and adjust annually for inflation, as we discussed. But in down markets, we reduce withdrawals by about 10% during years when the portfolio drops by more than 10%. Now, in up markets, we do the opposite. We increase withdrawals by 5% when the portfolio grows by more than 15%. So 2023 and 2024 would be good examples when the couple would enjoy higher withdrawals. Now, this strategy provided flexibility to preserve capital in downturns and capitalize on strong markets. Step 3, crafting the investment plan. Now, with only 5 years until retirement, ChatGPT proposed a moderate growth-focused portfolio to bridge the gap between now and age 60. After retirement, the portfolio would shift to a more conservative allocation. You might wonder, what's ChatGPT doing giving out financial advice? Well, this is what's happening, folks. Pre-retirement portfolio, so ages 55 to 60 for these folks. ChatGPT thought that being in 70% equities would be a good idea, US large caps making up half of that, or 50% of the overall portfolio, with international stocks at about 20%. I don't necessarily agree with that, but this is what it suggested. It's not crazy. It wants 30% in fixed income, meaning intermediate term bonds. Those are generally probably going to be in the kind of 5 to 10 year range in duration, and 10% in alternatives. Once we get to the post-retirement portfolio, ChatGPT changes its tune a little bit from ages 60 to 95. It moves the couple down to about a 50% equity exposure focused on dividend-paying stocks. Why does it think that's a good idea? I don't know. Again, I would strongly disagree. But this is not crazy in terms of the world of financial planning and registered investment advice. And then still with the 50% equities, 40% fixed income, it's adding 10% in alternatives, maintaining those REITs and maybe some corporate notes for income. The AI projected that this portfolio returns an average of 6.5% per year after fees, supporting the couple's withdrawal needs while preserving capital. Step 4, ChatGPT wanted to work on some tax optimization strategies. So it outlined those strategies to reduce the couple's tax burden in a few different ways. One, it wanted them to convert their Roth IRAs. So between 55 and 60, it suggested converting $50,000 to $75,000 per year from their traditional IRAs to Roth IRAs, keeping conversions within their current tax bracket. Number 2, harvesting tax losses. ChatGPT even suggested that the couple should be selling underperforming taxable investments to offset gains during high-income years. And 3, strategic withdrawals. It wanted the couple to prioritize withdrawals from taxable accounts before tapping tax-deferred IRAs to minimize required minimum distributions, right? Those RMDs that start at the age of 73. Now we get to step 5. Stress testing the plan. Now we might think, well, ChatGPT, good job looking all these things up on the internet, but you can't do math. Wrong. ChatGPT is very comfortable running Monte Carlo simulations, just like your certified financial planner or investment advisor. So ChatGPT analyzed the probability of their portfolio lasting through age 95, and it came out with some results. A 95% success rate if withdrawals remain consistent, an 89% success rate if markets experience 2 major corrections, similar to 2008. I wouldn't even call that a correction, right? These are terrible, terrible outlier years. So 2 financial crises and you're still at 89%. Not bad. ChatGPT then went on to step 6, which is estate and legacy planning. So the AI recommends starting estate planning to secure the legacy by establishing revocable trusts to avoid probate, setting up healthcare directives and durable powers of attorney, naming beneficiaries in all accounts to ensure smooth transfers of assets, and will even help draft a checklist for your attorney, saving time and money during the estate planning process. Now, step 7 is really, really important, which is accountability and follow-up. Now, how is an AI model supposed to do that? Well, the couple wanted to make sure that they stayed on track. So ChatGPT suggests creating a schedule for financial reviews to sit down with it, right, on a quarterly basis to review portfolio performance and adjust as needed, and annually to revisit spending, inflation assumptions, and tax strategies. It even recommends apps like Personal Capital to track their net worth and future projections in real time, and a registered investment advisor, which is my favorite, Fisher Investments. So the outcome. This is really about confidence without any costs. ChatGPT's guidance helps a couple like this build a comprehensive financial plan that addresses every aspect of their retirement. And this will work for people in their 40s, in their 50s, in their 60s, maybe even some folks in their 70s who are still confused about what they need to be doing with respect to budgeting, investing, tax planning, and legacy considerations. The total cost, $0 aside from your time and effort. And it's not a whole lot of effort to ask ChatGPT these questions. So this example proves that AI tools like ChatGPT are already empowering us to take charge of our finances, delivering a level of detail and personalization that rivals any human CFP out. Professionals are still valuable for highly complex situations. I would certainly recommend them to business owners who have tens of millions in assets, a variety of public and private investments, and very complex tax situations. But most of us don't fall into that category. Most of us are in much simpler situations. And in those cases, AI has already bridged the gap between computer and human. Thank you so much for watching the Dean's List. Please like, subscribe, and share. We really appreciate it. It helps our channel out. And if you'd like to learn more about Cardiff's corporate notes, which could be a great piece of your fixed income exposure in your portfolio, it currently yields 15% on 2-year notes. If you'd like to learn more, please go to investor.cardiff.co. We'll see you on the next episode.